this is a basic problem on the accounts for general insurance companies, and in this entire chapter, in fact, what we are going to prepare, the different statements we are going to prepare are mainly three statements. One is called a revenue account. Second is the profit and loss account. 3, we have the balance sheet. Okay, so unlike banking companies that we have seen earlier, in addition to the profit and loss account and the balance sheet, we have yet another account which we will prepare before the P&L account. Okay, and that account is known as the revenue account. Alright, now what this revenue account means is that general insurance businesses or general insurance companies, they have different types of insurance businesses within themselves, right? Like for example, any general insurance company will have different categories of insurance like fire, marine insurance and so on. In the previous classes, we have already discussed those different types of insurance, isn't it? So under general, you may have fire, marine, motor vehicles, theft insurance, health insurance and so on. So each of these becomes like a separate department, right? And they also become like a separate profit center, meaning they have their own expenses, they have their own incomes, isn't it? They have their own claims and own premiums which cannot be mixed with the other businesses. Like the premiums which you are receiving from the fire business, the fire insurance business, you have to show separately. You have to show that this much income is come from the fire insurance business and the marine insurance business has made this much income, right? So for that purpose, what insurance companies or general insurance companies are required to do is prepare a separate revenue account. Okay, this revenue account is meant for every single category, every single insurance department which the company has. So you will have one revenue account for fire, you will have one revenue account for marine insurance and so on, giving you all the details of what income they have earned, each department has earned in that particular year, and what expenses that every department has incurred during that year, right? Normally we prepare one revenue account with many columns, right? Like for example, if let's say a business or this insurance business, it has two different departments. Okay, so let's say it has fire department and it also has marine department. Okay, so when we prepare the revenue account, we will make one revenue account but we will put it in two different columns. So we will write premiums. The incomes are in the form of premiums, right? So fire premium was this much, marine premium was this much. Then any other types of incomes maybe, okay, and any other reserves and everything. So fire, marine, we write it separately. So instead of preparing two different revenue accounts for fire and marine, we will prepare one and show different columns depicting the amounts for each one. Same way expenses like claims and commission and all other operating expenses of that particular department. We are going to show it here according to each one's columns. Is that clear? So this is what revenue account means. Once we get some profit over here, right, after minusing these incomes and these expenses, we are going to definitely get some profit, isn't it? We call it the operating profit. Okay, so this profit, what we get, this is going to be transferred to the profit and loss account. Understood? So this is somewhat like how we used to prepare trading and profit and loss account, if you remember, right? We used to have something called a trading account, which is generally not followed nowadays with the new format and everything. But the trading account would show gross profit, the amount of profit which you have made by purchases, sales, all other factory expenses, manufacturing and trading expenses, and whatever gross profit comes, we used to transfer it to the P&L, right? And finally in the P&L we used to get net profit. This is somewhat similar to that. We first prepare revenue account. We find out what is the profit or operating profit of each of these categories of businesses, insurance businesses that we have. We take that operating profit and go down further, transfer it to the profit and loss account, the actual profit and loss account. Is this clear? So from that we can tell, or again we can use those expenses, general expenses which the whole business incurs, we can put it in the profit and loss account. Expenses which are not particular to any type of insurance business, but they are more general in nature. Okay, so for now, at least in this problem, we are going to only look at the preparation of the revenue account. We will come to the profit and loss account, and the formats will be made available to you all, the performance will be sent to you all as to what the revenue account, P&L and the balance sheet of an insurance company looks like. Okay, so for now let's first create this revenue account based on all of these incomes, expenses and all of these items that are given to us. Okay. Now first thing, let's see, we will look through all of these and we will try to mark each one and where exactly they are going to go. Okay. Now although I have not, we can just look at the pro forma for insurance. So in the revenue account, the first thing or the first amount that we normally have is premiums earned. That is, we record the incomes first. So premium being an income for an insurance business, we first write premiums earned. Okay, and this premium will be calculated under schedule 1, right? Then we have the second item is something called changes in provision for unexpired risk. Now what this means is, for any income, now normally we have something called provisions for advances in banking that we have learned. We have provisions for doubtful debts, isn't it? So whenever we are supposed, or whenever we are expected to receive certain incomes, like for example premiums, isn't it? People or clients of the insurance company pay them premiums on a regular periodic basis. Now a lot of times those people may forget to pay their premiums, or suddenly people stop paying premiums of insurance companies, right? And their policies lapse. We use the word lapse, isn't it? Like if you don't pay your insurance premium over a very long time, like they have given you the grace period, they have waited for years for you to come back and pay that premium, but you did not pay, correct? So the policy tends to get lapsed, meaning it is now stopped. You will no longer get any insurance, fine? So in such cases, the insurance business needs to make a provision. Provision is like a reserve, okay? It's like a what I call it normally is what if. It's like a what if. So what if people don't pay? What if premiums don't come into the business, right? So we need to make a provision. It's like a backup so that we don't count too much profit, right? We need to make some provision, some reserve for the likely losses that we might face, right? So you have to assume that people may not really be regular in making the payments of their premiums, and which is why you need to make this provision for something called unexpired risk, right? Keeping in mind that you might have, or you might suffer some losses if people do not pay the premiums in time. Okay, so we'll see how these provisions work. By changes in provision, I mean provision of the previous year and provision of the current year is compared, and whatever the difference is written over here. Only the changes, only the difference between the opening balance and the closing balance of the provisions. Fine. So under incomes we have only these two, and then we get the total, right? Next, then we record expenses, where we don't really write the words income and expenses, but the format just requires to write this. We have claims incurred, which is the second schedule. So if you have paid claims to your clients, let's say somebody did suffer loss or damage and they claimed their insurance money back. Okay, in that case, if you have incurred claims, then you have to make those payments to your clients and you have to show this. It's a type of an expense for the business. Okay, next is commission. Fine. So this is generally the commission paid. We always write it as commission paid because these are under expenses. Okay, so this is commission paid, and even if commission is received, then we adjust it with this commission paid. Like in the schedules that we will prepare 1, 2, 3 and 4, we will adjust whatever commission is received, paid, everything at once, and we will get a final amount to transfer here in our revenue account. Okay, so third schedule is commission paid. Fourth is operating expenses related to, now these are operating expenses not related to the full business. Like it does not include everybody's printing and stationery, everybody's salaries, everybody's administrative expenses. These are operating expenses related to only that particular department. So in this example, the department is the fire revenue department, right? The fire department, fire insurance. So these operating expenses will be those which are related to only that fire insurance business. Is this clear? So operating expenses related to fire insurance. All other type of operating expenses which are not only of the fire insurance department, but they are of the whole company, right? Like say for example, if you buy printing paper, or if you buy some stationery, pens, pencils, erasers, whatever, you're not going to buy it only for fire insurance department, isn't it? You're going to buy it for the whole company and then distribute it to all the departments, right? So that sort of expense is a general expense. It will go in the P&L. But expenses only related to fire insurance, like say for example, there are 4 people employed in the fire insurance department. So the salaries given to these 4 people, they will come under operating expenses related to fire insurance because it's revenue account, right? Okay, and this is schedule 4. After minusing the totals of this incomes and these totals, what you get is operating profit from fire insurance. Operating profit from fire insurance, A minus B. Okay, so this is A and this total is B. Minus the 2 and you get operating profit from only this business department, that is the fire insurance department. Fine, and that although we don't have the P&L account preparation for this problem, this profit is normally transferred to that P&L account.